Welcome to the School of Economics. We are studying public finance, and this is Chapter 8, Part 4, Measuring the Fairness of Tax Systems. First, we'll talk about the differences between average tax and marginal tax. Let's get started. So, notion of fairness is relative, right? So, tax fairness is a really important concern to citizens in all countries. So, Margaret Thatcher proposed the poll tax in 1990 in United Kingdom, Britain. Okay, so this tax would be levied a flat charge equally on all individuals regardless of income. This caused riots. So imagine if the government said everybody is going to pay $20,000, right? Even if you're a millionaire or even if you made $20,000, you're all paying $20,000. So this caused a lot of issues. What is the marginal tax rate? Marginal tax rate is the percentage that is paid in taxes on the next dollar earned. So all those tax brackets are given in marginal tax rates. For instance, Josh's taxable income is $150,000. His gross income was $170,000. Okay, so this is his taxable income. His marginal tax rate is 24%. So that's the last dollar. If he made $150,001, that last dollar taxed at 24% rate. Average tax rate is the percentage of total income that is paid in taxes. So almost always average tax rate will be less than marginal tax rate unless you're in the first tax bracket. So Josh's average tax rate is, for instance, 17.69%. This is a tax bill as a percentage of gross income. So let's do a practice question, learning by doing. The nation has a tax rate of 10% on the first $10,000 of taxable income. Okay, so if you made anything between 0 to 10,000, 0 to 10K, you pay 10%. Okay, then 15% on the next $20,000. So from 10 to 30K, you pay 15%. Then 20% on the next 30,000, that means 30 to 60K, you're paying 20%. And then anything beyond 60K, you are paying 30%. Okay, cool. So there's a $4,000 exemption per family member. So each family member, your taxes are reduced by $4,000. Anand's family has 8 members. 8 times 4,000. Okay, 4,000, $32,000. Okay, so it earns 80,000 per year. That's a very crowded family. 80,000 minus exemption. This is the exemption, $32,000. Okay, so what is this? $48,000 is his taxable tax base. So let's find how much tax he pays. For first $10,000, right, he's paying. So we're going to do this till he hits 48,000. So out of first $10,000, he is going to pay 10%, 0.1. So this is $1,000. This is his tax bill. We're going to add it up. From 10,000 to 30,000, that's a $20,000 in that bracket times 15%. 15%, that's going to be $3,000. And from 30 to 60, he's exactly in this group. You know, first of all, what's his marginal tax rate? Because his tax base is 48,000, falls into here, it's 20%. It's his marginal tax rate. But in this question, we're asked the average tax rate, okay? So from 30 to 48, there's $18,000. That is taxed at 20%, 0.2. So that's $3,600. We are done. So we're going to add everything. 3,600, 3,000 plus 1,000, $7,600. So this is his total tax bill. What's this family's average tax rate? Okay, so how can we find this? The correct answer is in the next slide. So you basically put this total tax paid, divided your earnings as family, $80,000. So if we calculate that, I am going to use a cell phone. Okay, let's do this. I'm going to use a cell phone, and you have probably answered that. 7,600 divided by 80,000. Okay, that is going to be, it is 0.095. This is 9.5% is the average tax rate. What's marginal tax rate? That is 20%. Do you see it? Marginal tax rate is 20%, and the average tax rate is much lower than that. Okay, so let's talk about statutory tax rates. These are tax rates laid out in the legal tax schedule. Effective tax rates are the tax rates an individual actually ends up paying. Okay, so these two diverge because of due to different exemptions, deductions from the taxable income, which reduces the tax base. For instance, homeowners can deduct their home mortgage interest rate. I had to think about it. Also, PMIs, private mortgage insurance, if they paid, for instance, less than 80% of their home value. So they can deduct those. Therefore, statutory and effective tax rates do differ. And in the next part, we are going to go deeper into measuring tax fairness. We're going to learn about vertical equity and horizontal equity. I'll see you there.